Hello, my name is Robert Gowding and I'm a financial planner with Meriton Financial Group. And during this session, we're going to discuss the First Home Savers accounts. Now, for many young people and not so young Aussies, the great Australian dream can be exactly that, just a dream. But if you look closely, it can be possible to make your own home reality earlier than you might think. Now, regardless of what new features are offered with home loans, the smartest way to get the best mortgage deal is still based on how much you've saved, how much you've got for a deposit. If you don't already have a savings habit, launching into a huge debt to purchase your first home is not the best way to start one. So for first home buyers, building a deposit is absolutely vital. Now, to assist, the government has introduced the First Home Savers account, which is a perfect launching pad to build a substantial home deposit. These accounts operate in a similar way to a superannuation fund, with concessionally taxed treatment on the income that the fund earns and the potential for a government co-contribution. To be eligible for the First Home Savers account, you must be first a first home buyer aged between 18 and 64. Couples can have an account each, and there's no contribution limits on how much you can put in each year, but needs to be made with after-tax income. And the government will make a co-contribution equal to 17% of your contributions up to $5,500. And so that's a maximum contribution of $934. You must lodge a tax return to trigger the contribution payment, and the interest that you earn on the accounts are only taxed at the superannuation tax rate of 15%. You have to save at least $1,000 each year over at least 4 financial years before you can withdraw the money. It is capped at $80,000, but this cap is indexed into the future years, so it will go up. Now, if it's not used for a home, the money is then added to your superannuation benefits and you cannot access till age 65. The full benefit must be withdrawn and the account closed. As an example, let's say we've got a young couple begin a 5-year plan to save for a house deposit. They both open an account in their own name and they can afford to put in $75 per week for 5 years. At the end of the 5 years, both will have just under $26,000 or combined nearly $52,000 for their deposit. Now, there's a few tips and traps to consider. If you buy your first home before the 4-year period is up, you can withdraw the money in the account at the end of the 4-year period and then put it towards your mortgage. After the settlement, you cannot make any more contributions. First Home Savers accounts can only be opened by an individual, so there are risks for couples who choose to just have one account between them. So then you have the issues of obviously relationship ending, or you actually don't buy a house together. So keep in mind there's also no restrictions on who can contribute to a First Home Savers account. So if you have any generous parents or grandparents who would like to contribute towards the purchase of your first home, this is an absolute perfect way for them to do it, considering there's an extra 17% government contribution. So what's a reasonable deposit? I'd say if you have 20% or more of the purchase price, you will avoid paying mortgage lender's insurance. And of course, the bigger the deposit, the bigger the impact it will have on the interest you've paid over the long term. So thanks for listening. I hope it's been of value. And please remember this information is general advice only, and I encourage you to have a read of our general advice disclaimer at the end of this video. Thanks very much.